options at theocc.com is an email address that is staffed by 4 people, myself being one of those 4 people. Amongst the 4 of us on that investor education desk, we have over 100 years of industry experience, either in trading or brokerage or clearing. And what we do is answer questions that people send to us all day long, every day. It's a free of charge service that we offer to the public. Make sure you utilize that. It's important to understand we're not registered investment advisors, so we can't direct you on trades or suggest investment strategies. But what we can do and what we're really good at is educating people as to how options work and making sure they utilize that knowledge when they're moving forward in their trading. So let's get right to it. I always start presentations with volume from 2000 up to 2023. It's important to understand how much this industry has grown. If you think about 2008, which is always a kind of flag that I stick in the ground to make sure people understand how much we've grown. 2008, I was trading SPX options on the floor of the CBOE. I looked up at the end of the year and we had cleared 3.7 billion contracts. That was the most volatile environment I had ever seen in my entire life. Kind of up until this point, still the most volatile environment. But to put that in historical perspective, last year we did 11.2 billion contracts of cleared volume. This is not going away anytime soon. The metrics for this year are pointing towards north of 12 billion contracts for the year. What that means is that people are more involved and there's more people involved in this marketplace. That's the only way we could be seeing these metrics. What that means from my seat as an educator is it becomes more vital what I do to teach people how these leveraged instruments work and to make sure that they understand how they work before they start trading. So let's get right to it. We're going to talk about the steps toward daily expiration. How did we get here? Options didn't always have the same cadence of expirations that they have currently in some products. But how did that happen? I'll give you a historical perspective on how that happened. What we're going to talk about as far as the options are concerned, the sensitivity of options as time passes. How does time and optionality, how are they related? How does one affect the other and vice versa? We'll dig into that in a couple of different ways. One is the gamma of options over time. The other is going to be the vega of options over time. I will explain to you if you don't understand what these terms mean. I'll explain what they mean, and then I'll also talk about how they affect the options. Then we're going to talk about the delta of options and how it's related to time. And I'll give you this thing at the end called a move comparison. The move comparison is meant to show you how the same option that just has a little bit more duration in it is going to move. Russian, for instance, that has 10 days in it or 5 days in it or 0 days in it is going to move relative to something that might have like 90 days in it. It's meant to give you a broad perspective on how time and optionality are connected. That's what we're going to get to. Hopefully we'll have some time for Q&A at the end. To begin with, let's talk about DTE, days to expiration. What that means is that a 30 DTE option has 30 days to expiration in it. A 10 DTE has 10, a 5 DTE's got 5, and a 0 DTE has 0 days to expiration in it. What that means is that a 0 DTE option that you hear all about, or that you're maybe currently trading right now, is merely an option that has reached its expiration date. In a general sense, every single option that has ever existed has at one point in its life cycle been a 0 DTE option, namely on the day it expires. And so there's a lot of talk especially in the financial press, about 0 DTE and how it's this new phenomenon that has happened. What I'm going to show you is that it's not necessarily something that people cooked up in a lab and dropped onto a marketplace, but that it's been a gradual, actual progression, and how that has happened and how the volume has changed over that time frame, because that's really instructive as to how these options have evolved over time and why. So with that said, let's get right into it. The steps toward daily expirations. How did we get here? I can tell you that when I started trading in 1999, we didn't expire options every single day. We expired options on the third Friday of every month. There was one monthly expiration a month. That was it. And if you were trading options in that month, they expired on the third Friday. Now, what has happened since then is that the cadence of expirations has changed, but it's happened gradually. In 2005, they added weekly expirations, but weekly expirations only happened on Fridays. I remember being on the floor of the CBOE, and they used to have these what they called information circulars that would come around that were actually pieces of paper that they would print out, 10,000 of them and hand them out to every single person that was making markets on the floor as a way for the CBOE to tell its members what kind of changes were coming down the pipe or what changed relative to one specific, post or station in which there was going to be a listed security. What that circular said was, guess what? There's not going to be only one expiration per month anymore. We're adding Friday expirations. Think about what that means from a risk perspective from a market maker. I used to have one risk event per month. And then all of a sudden they were telling me it was potentially going to be 4 of the favorite development as far as my risk is concerned. However, what we started to realize from a market making perspective is that these were not only risk events, they were also opportunities. And the reason why is because volume started
Recording in progress.
When Wednesdays were added. Wednesdays were the first time that a regular expiration cycle did not terminate at the end of a trading week. All of a sudden, you would have Wednesdays and Fridays. Now, at the time they listed Wednesdays, more than 30% of index volume was already centered in these weekly options. Now, I put this in here as a way to point you to some real data, because oftentimes you're going to hear the financial press talk about these options and this volume migration as something that has just happened and that was dropped onto this marketplace and might be considered a systemic risk. What I'm here to show you is that this has been happening and the volume has been centered in these weekly options for a very long time. This is not a recent development. So Wednesdays added in 2016. Guess what? After Wednesdays happen, Mondays also get added. What you have then is Mondays, Wednesdays, and Fridays. In certain products, you would have Monday, Wednesday, Fridays every week. Now, at the time, you're still dealing with 30% of volume having migrated into the front of the curve in these Monday, Wednesday, Friday expirations. Then another 5 to 7 years goes by, and finally we get this rounded out cycle when they add Tuesdays and Thursdays in 2020, and you end up with Monday, Tuesday, Wednesday, Thursday, and Friday expirations for certain products. At this point, what you're seeing is north of 40% of volume in index products being in the weekly options. And in some places, it was north of 45%. What I'm trying to tell you is this took a long time for us to get here. And the actual cadence of expirations is what has been changing. These are not newly created options. These options have the exact same optionality that every option has always had. It's just that now we have a different cadence of expiration. And it took us 17 years to get here from 2005 to where we are now, where in some products, you'll see Monday, Tuesday, Wednesday, Thursday, and Friday expirations, which all of a sudden also now has a new name. It's called 0DTE options. So let's talk about how the options themselves work when you're talking about time and optionality. How does time influence option pricing? Let's talk more broadly. Delta. Delta is the actual rate of change of an option's price per $1 move in the underlying. It tells you how much your option should move if your underlying move's a buck. Now, as expiration approaches, as you take time out of an option, the options that are in the money tend toward the upper bound of 100 delta. Meaning, if you have an option that is a 90 delta option and you pull days to expiration out of it, it goes from 10 days to 9 days to 8 days to 7 days, and nothing else changes. What you can expect is that option delta is going to move up toward the 100 bound. Conversely, if you have an out of the money option that has a 10 delta, it's going to move as time pulls out. The delta is going to move toward the 0 bound. So what you end up with is these options that are moving in two different directions. The at the money options are still 50 delta options, but these in the money options are moving more toward the 100 bound, and the out of the money options are moving more toward the 0 bound. They're doing this. The disparity between the deltas is starting to widen as time passes. That's very important when you're thinking about delta decay over time. Gamma of options. Gamma is the highest in short-term options and at the money options. Now, gamma is the rate of change of the delta. So it's technically a second derivative Greek. It's telling you how much your delta is going to change. Keep in mind, your delta is always telling you how much the value of the option should change when the underlying moves, but the gamma is telling you how much is your delta going to change. Gamma is most concentrated in short-term options and at the money options. As time passes, gamma increases for at the money options and decreases for out of the money options. So as you can imagine, and I'll show you on one of these slides coming up, the gamma of these options as you get closer to expiration is exploding. They become very sensitive to underlying movement. Why? Because their gamma is increasing as you get closer to expiration. The other thing that comes with that is theta. Theta is the measure of an option's decay for one 24-hour time period. And if you think about theta and you think about time, you can imagine that pulling 1 day of time out of a 100-day option is 1 out of 100. Pulling 1 day of time out of an option that has 3 days is 1 out of 3. That's a very different percentage of that option's valuation, and that's going to be commensurately exhibited in how much theta comes out of these options on a day-to-day basis. As you get closer to expiration, your theta is going to increase, especially if you're dealing with options that have extrinsic value in them. It's generally centered around the extrinsic value portion of an option's value, not the intrinsic portion. Intrinsic value in options doesn't decay. It doesn't have a decay feature like extrinsic value does. With 0 DTE options, this theta is concentrated because of the limited amount of time. So what you're getting is gamma and theta that are increasing as you get closer to expiration. Vega, another important part of how these options are actually measured. Vega is proportional to time. Generally speaking, if you're talking about an option that's at the money and you add time to it further out on the duration curve, that option is going to commensurately have more and more and more Vega as it gets longer term as far as the duration is concerned. And that means that that option is going to be more sensitive to implied volatility moves. It's going to move around a lot more when implied vol moves. That is in direct contrast to the amount of theta and gamma that these options have in the front of the curve. I'll show you that when we get there. The gamma of options, let's dig in a little bit into the gamma of options. Like I said, gamma is the delta's change, the delta's sensitivity to underlying moves. The anticipated change for the delta in a $1 move in the underlying security. Now, gamma is something, if you think about all the other pricing factors remaining constant, you can think about how gamma is going to change your option if something moves by $1. It is generally expressed as decimals, just like many of these Greeks are. So in this case, this would be a 2 gamma option. And it is really concerned, it's really characterized as like an adjustment to your delta. Now, only options have gamma. Only options have the ability to change their delta. That's what gamma is. It's the rate of change of delta. And this is where that optionality comes from. This is why people buy and sell options, because of the ability of these instruments to change. This is where the leverage comes from within these actual contracts. Let's look at how gamma looks across a set of strikes in an underlying. In this case, I want you to think about this as a $25 stock, $25 stock. And these are the strikes across the bottom, the 20s, 21s, 22s, 23s, 24s, et cetera, et cetera. That would mean that these are your in the money calls or out of the money puts. These are your out of the money calls, upside calls, or in the money puts. And these are your at the money options. It's pretty easy to see where the gamma is concentrated. And this is relative to strike. Now, if I were to show you what it looked like relative to time, you're going to see as you pull time out, this actual amplitude becomes greater. It becomes more pronounced in the at the money options. And as you put time into an option or add duration, it gets flatter. The gamma curve across these strikes. This is what you need to remember about gamma. It's most concentrated in at the money options. These are your at the money options. These are your 0 DTE options. The at the money has the most gamma in these short-term options. Let's look at it as a function of time. This is what I was talking about when I'm talking about what it looks like when you add or subtract time from an option. What you just saw is what it looks like within 1 month. The strikes. It's most concentrated in the at the monies. Now let's look about what it looks like when you add time or take time away. This is going to tell you these 0 DTE options, the at the money option has 15 gamma. The same option with 5 days in it has 6. The same option with 10 days in it has 4, 3, and less than 2. You can see what this looks like when you look at the numbers on it, but it becomes much more apparent when you graph it. If you look at how much gamma is in this 0 DTE option relative to a 90-day option, it's very stark. The difference is very stark. There is a chasm of difference between the gamma that exists in these 0 DTE expiring options and the gamma that exists in an option that has 3 months in it. It's massive. And the difference mostly comes in this front bucket from the 0 to 10-day. That's where things get exponential as you get closer to expiration as far as gamma is concerned. So that's something I want you to think about when you're thinking about 0 DTE options. They are very gamma-centric options, meaning they're very sensitive to underlying movement. Now, another way you can think about this is the vega of these options over time. I'm going to give you the exact same thing, the 0 DTE, 5-day, 10-day, 30-day, and 90-day option, but we're going to look at it in terms of vega over time, because this is also pretty instructive. When you look at these numbers over time, you'll see that vega increases commensurately with the amount of duration, right? It goes farther out in time and it's more pronounced as you add time to an option. So what you end up with is these options in the front of the curve, these 0 DTE options or the weekly options that have a very interesting mix of risk dynamics. What do they have? They have very little vega and they have lots of gamma. And that's what this looks like as a 0 DTE option. This is how you can think about these options in the front of the curve. This is duration. Again, 0 days, 5 days, 10 days, 30 days, and 90 days. You'll see the vega of these options up front is very, very low. And the gamma of these options up front is very, very high. And so what you have is a very stark kind of risk dynamic that exists in these options. Your 0 DTE options, if you're looking for an option that's going to give you vega coverage, is not going to give you a lot of vega coverage. It's not going to move around a lot when you move implied vol around. It's going to be extremely sensitive to underlying movement, but it's not going to give you a lot of vega coverage. And conversely, in the back of the curve, These 90-day options are even further. You're going to get a lot of implied vol sensitivity and very little movement sensitivity in the underlying. These have a lot of vega and very little gamma. So it's exactly the opposite as you go out in time. Let's talk about delta over time, because this is an interesting part of how these options interact. Delta is an option value sensitivity to the stock price. It's going to tell you how much this option should move in price when the underlying moves a buck. Deep in the money options approach that 100 delta that I talked about earlier. Remember when I talked about this at the beginning? As time comes out, in the money options become more in the money, and out of the money options become more out of the money. The delta characteristics of these options start to move toward their boundaries as time comes out of them. So in the money options tend more toward the 100 bound, and out of the money options tend more toward the 0 bound as time passes. Now, at the money options stay the same. At the money options, the exact at the money option is always going to be a 50 delta right up until the point that it expires. And when it expires, you have to figure out which side of this it's going to be on. Is it in the money or is it out of the money? Sometimes you get options that expire and the actual underlying pins the strike. And in that case, both of those at the money options, the 50 delta call and the 50 delta put, will remain a 50 delta, because at that point, no one really knows whether or not the call is going to be exercised or the put's going to be exercised, or you're going to get assigned if you're short the call or short the put. And so those options stay around 50, but the in the money options tend toward 100 and the out of the money options tend towards 0 over time. Let's look at what this looks like as a function of strike, because this is kind of interesting. When you're thinking about delta of these options, this is that curve that I was telling you about as far as time is concerned and optionality and delta. This, if we're talking about this being a $25 stock again, this is your at the money strike right here. And these are your, let's call them in the money calls. These are your out of the money calls or in the money puts. Think about how the delta interacts as far as time is concerned. When you pull time out, these options are going to all move more toward the 100 bound. And these options are all going to move more toward the 0 bound on the call side. If you overlay the gamma of the options, you're going to see that this 50 delta option, which stays a 50 delta right up until the point that it expires, also will have the most gamma right up until the point that it expires as well. This is what delta and gamma look like overlaid as a function of strike. So what we have thus far is delta moving more towards its boundary of 100 and more towards its boundary of 0 as we pull time out. We have gamma, which is becoming more pronounced as time is coming out. As you get closer to expiration, these options have a lot of gamma. The theta of these options is also increasing as you get closer and closer to expiration at an exponential rate. And the vega of these options is kind of going away as you get closer to expiration. So you have an option that is very sensitive to movement. It has a lot of gamma. It has a lot of theta. It has very little vega. And its delta is moving around either if it's in the money toward the 100 bound or if it's out of money toward the 0 bound. That's how these things move when you pull time out of them. Let's look at a theoretical move in a stock and how this might look when you're dealing with an option that has differing durations. So let's look at the 0 DTE call to begin with. We're calling the same move, different result. You've got a 0 DTE 50 delta call. This call is starting as a 50 delta. Now, it has 0 days to expiration. It's expiring today. The underlying is trading $100. This is a $100 theoretical stock. We also have an implied vol of 50%. This call price starts today at 105. And it has, remember, these options have a lot of gamma. This is a 15 gamma option. That's a significant amount of gamma. Now, the same option with 10 days in it. Oh, look at all these things. They're all exactly the same, except the amount of days and the price and gamma. The Greeks on these options are going to be different because they have more days in them. But this is meant to drive home the point that this is the same 50 delta option just with 10 days in it. Has all the same metrics, but the gamma is much different. You can see it's a third of the gamma of this zero DTE call, and that's only with 10 days in it. Now let's look at the 30-day option. Same 50 delta call, same stock. You've got 30 days to expiry. Stock's trading 100, and the vol is still the same, 50. But this call is worth $6. That's a function of how much time is it. It's also a function of how much vega is in it. But its gamma is 0.027. That's very little gamma relative to this amount of gamma. Now, I want you to think about these three options: the 0-day option, the 10-day option, and the 30-day option. And now we're going to move the stock up $5 in all three of these options. So what happens to these options? Remember, gamma is the rate of change of the delta of your option. And that also affects the valuation of the option itself through its delta. So now what you've got in this case, stock moves up $5 in all three of these option cases. We're trading 105 now. The new call price for this option, 0-day option, it's expiring today, remember. So it's going to move very closely to its actual intrinsic value or to parity. That means that this call is now worth $5 or a little bit more than $5. This call is worth $6.70. And this call is worth $9.04. These are all theoretical values, but you can do things like this by using the option calculator on the OIC website. You can look at what this might theoretically look like. What I want to drive home here is not the fact that when you look at these numbers, you could make a case that they're relatively similar. $5 a movement, $6 a movement, $9 a movement. But the real difference in these options is they've all moved relatively the same amount, not that much, right? This one moved $4, this one moved $3, this one moved $3. Think about what that means relative to what they cost to begin with. This option moved 378%. This option moved 89%, and this option moved 50%. This is why all of those people that you hear talking about systemic risk and all of these things with 0 DTE, this is what they're talking about. What they're talking about is because of the way that these options are structured on their last day of expiry, and it's really because of the way that every option is structured on its last day of expiry, this gamma is going to affect the actual price of this option significantly on the same move that you're dealing with. This is a $5 move in all three of these different scenarios. But because this call only has 1 day in it, today, it starts the day only worth $1 or 105. And so when you get that $5 move, it goes to $5, which is a massive difference between spending $3.50 on a call that ends up at $6.70 or spending $6 on a call that ends up worth $9. You're dealing with much different percentage changes relative to the notional value that these options start the day with. The reason why is because of what we talked about at the beginning. These options only have what we would call one price iteration of settlement in them. There's only 1 day that matters, and that's today. And so when you're pricing an option that it's a 0-day option, you can't price it like it has 90 days of underlying iterations of settlement in it because it doesn't. Those options have lots of vega and not a lot of gamma. These options in the front of the curve, these 0 DT options, have a lot of gamma and not very much vega. And that's what you end up with when you're looking at a move like this. Here's the flip side of that coin. And this is the actual theta part that we haven't talked about very much yet, but is very important when you're talking about options that are in the front of the curve. Same slide, same move, different result. Now we're going to function now we're going to focus instead of on the gamma of these options, we're going to talk about their theta. Because remember what I said, with the increase in gamma comes an increase in theta. There's a big difference between pulling 1 day of time out of an option that has 3 days in it and 1 day of time out of an option that has 90 days in it. Think about that relative to the amount of premium that's in an option as we go forward. We're dealing with the same thing here. This is a 50 delta call. Remember, 0 days to expiration. It's expiring today. Underlying's 100 and the vol is 50 again. Same situation. Call's worth $1.05. How much theta is in this call? All of it. All of the value of this call is in theta, is going to theoretically, if the stock stays right where it is, all of that value is going to expire by the end of the day. This is the big difference when you get close to expiration as far as theta is concerned. Let's look at the 10-day option. This is the same thing, right? It's a $3.50 option. How much theta? If you fast forward your clock 24 hours to this exact time tomorrow, this option should move by 16 cents, should decay by 16 cents. That's a big difference here, right? A big difference. And then the actual difference becomes even more pronounced when you add a 30-day option. This option is only going to theoretically decay, if we fast forward to tomorrow, only 10 cents. 10 cents out of $6 of call value, essentially. Now, instead of the example that I gave you where we moved the stock up $5 and looked at how all of these calls changed over time, we're going to look at what happens if we get an unchanged market. Nothing happens. You walk in the morning, you've got a call that's worth $1.05 in the 0 DTE, and then at the end of the day, the stock is trading exactly where it started. Nothing has changed. What's your new call price here? Guess what? It expires without value. Your new call price here, remember, theta is basically just an estimation of how much you're going to decay that option over a 24-hour period of time. And in this case, you got 16 cents of theta coming out of a $3.50 option. New call price here, $3.36. That's your 10-day option, which now would be a 9-day option. Your 30-day option, which is going to be a 29-day option afterwards, new call price is $5.91. That's 10 cents off of where we started the day. This calls down $1.05, its entire value, because its one price iteration has just passed. It has expired. This call is down 17 cents, and this call is down 10 cents. Let's look at that in percentage terms to drive the same point home. These 0 DTE options are going to move a ton based on their percentage by the end of the day if nothing happens. Why? Because they all expire. They don't all expire. Yes, they all expire, but the value, the extrinsic value portion of that option goes away at the end of the day. That entire amount of premium is built into its theta. Why? Because for this option, there is no tomorrow. This option is done. In this case, you've got 5% of its value coming out because it's got, guess what, 10 days or 9 days after that is happening. And in this case, you've got 2% of the option of its value. This is the function of theta that we're talking about as far as how do theta and time affect each other. As you get closer to expiration, you're getting more theta as a function of how much of that premium is actually in the extrinsic portion of the option. And in this case, it's 100% extrinsic premium. And when you think about extrinsic premium and time, extrinsic premium comes out when an option expires. And so that's why these options have such massive changes at the end of that one day. This is meant to drive home the idea that time and optionality are very, very connected, but in different ways when you look at different Greeks. Remember, as you get closer to expiration, options gamma explodes, options theta explodes. That's what we just looked at here. And the delta tends toward 100 or toward 0, depending on if it's in the money or out of the money. And the actual vega portion of the option, which is commensurate with time, is going to disappear. That's how these options work over time. It's important that you understand the theoretical basis of how this works. That's part of the reason why I designed this presentation the way that I did, because I want you to understand how those actual concepts work. Because guess what? This concept is applicable in so many different ways. It's not just zero DTE options. I want you to think about this in terms of optionality and time, because you can also use this concept, this framework, to think about the difference between a 30-day option and a 60-day option, or a 10-day option and a 50-day option. What do those look like from a risk reward perspective? What do the risk metrics look like relative to what I want out of this option? And is this what I'm looking for to hedge in the way that I want to hedge, or to speculate in the way that I want to speculate? And how will this option move if things move in the underlying? So that's basically the entirety of the information. I want to make sure that you understand that zero DTE is not something that's been cooked up in a lab. All of these options have been zero DTE options at some point in their lifetime. And that what we've done is change the cadence of expiration. So you're seeing it more prevalently and more frequently, but it's not some new concept that has come out of nowhere. So optionseducation.org. Please check out our resources there and send us emails at options@theocc.com, which you'll see right here. Let me see. Stage. Let's take a look and see if we can take some time to look at Q&A.
Yeah, there were a few that addressed selling options too. So, but there are some good questions in there.
Okay. Calendar days or trading days? Well, these options are, when you're talking, especially when you're talking about theta, it's in calendar days. The thing that I always talk about when I talk about theta is that theta doesn't care if it's a weekend or if it's a holiday or if it's, or if you're in Turks and Caicos. Like, theta is done per calendar day for options. So the way your model is probably going to think about it is fast forward 24 hours and pull that time out. That means that, and pull that value out. That means that if you have a weekend or a long weekend, like a 3-day weekend, what we used to talk about is like 3 days of theta is what we talked about when we were leaving on Fridays. Now, that doesn't always come to pass. You don't always get to keep 3 days of theta if you're short the option. Sometimes things move and you come in on Tuesday and things are different. But calendar days or trading days, it's done in calendar days. Do you think eventually single name stocks will have daily options like many ETFs do? This is a fantastic question and something that's on the mind of many options professionals out there. My official answer is that's likely not going to happen anytime soon because of the differing, as you get into stocks, there are different risk events that exist in stocks that don't necessarily exist in indexes. In many ways, an index is a perfect place to have zero DTE options and daily expiries because there aren't things like dividends and real, like, specific risk events that are very specific to that option, that name. When you're dealing with something that has a much more broad-based representation of the marketplace, like an index, you have something that's further diversified and easier to do. Having said that, I do think that we are moving in that direction as far as the way that people like to use optionality has started to move. And like I showed you at the beginning, it's been happening since 2005. The duration of these options that people like to use for specific purposes has started to shorten. And I don't necessarily think that's something that's only going to exist in a tiny little set of products. When you think about the way that exchanges respond to their clients, I always talk about this when I say, if you're a bridge builder, you build bridges. And if you're a home builder, you build homes. And if you run an exchange, you list options when people ask you to list them. Now, it's your job to figure out whether or not the actual business case is good enough that it's going to generate enough revenue to pay for all of the actual systemic expenses that you have to pay for when you do something like that. And that's for each exchange to make that decision based on their own metrics. However, when people ask for options to be listed in very specific ways, generally speaking, the exchanges want to provide optionality for them. And so what you're starting to hear is more people ask this very question. Are we going to have daily expiries in stocks? I don't know the answer to that, but I do know that exchanges generally respond to their clients when their clients ask for things. Who controls the gamma and delta values? How are their calculations determined and regulated to not be predatory? It's an excellent question. Gamma, well, all of the Greeks are risk metrics that are provided by the model that's being used. So, for instance, no one is providing a specific delta for the entire marketplace. Many times, this is actually kind of interesting. Many times, as a market maker, you would be standing right next to someone who would be making markets in the same stuff that you're making markets in, and they would have a completely different delta for the option that you were trading. You would both be trading it. You both be paying $2 for the call. And instead of selling 46 shares of stock against it, they would sell 40 shares of stock against it. And I'd be like, what's your delta for that option? And they'd say, oh, it's a 40. Wow, I have a 46 delta on that. That's a function of the model that you're using. And everyone uses a different kind of tweaked model. And so things like delta and gamma are a function of the model that you're using. They are also a function of time, like we just talked about, and something called implied vol. Implied volatility has a big is a big part of how an option model generates valuations. If you want to ask questions about how implied vol and delta and gamma are related, send us emails at options@theocc.com. So further from expiration equals a less volatile gamma. I can't tell you whether or not it equals a less volatile gamma, but what I can tell you is that if you're further away from expiration, that option is going to have less gamma in it than the exact same option that's closer to expiration. And it's going to have more looks like this and vega that looks like this. So the 0 DTE option is right here. Lots of gamma, very little vega. Can you address how institutional traders trade the Greeks for both P&L and portfolio hedging? This is an interesting question. The bottom line is this. Institutional traders have proprietary ways that they hedge. Some of them hedge in a delta neutral way, meaning every time they have delta from option trades, they have to hedge it out with the underlying. Some of them don't trade that way. I get a lot of questions about how the large players are actually hedging these trades. And the reality of the options market is that you can't tell how the person is hedging after the trade happens. You can't even tell how the person is hedging even if you trade it delta neutral, because they can trade it delta neutral and then trade a certain amount of stock against it in the opposing direction. The hard part about this is trying to figure out, and many people try to do this, try to figure out what the large players have as far as inventory is concerned, and then how they're hedging that, because they think that it's going to give you some like ability to look into the marketplace and understand how the underlying is going to move. The reality of the situation is that it's not going to give you that kind of transparency that you're looking for. What you should really concentrate on is, how do I want to hedge it? What do I think is the right delta for this option? Or Do I want to sell stock against this option? Does that fit with my investment goal? Do I think that this is the right trade against this option? And that's really where I think you should start to really focus your attention in those situations, because what that does is it puts the onus on you to make sure that you're making the decision that you want to make and that it aligns with your investment goals. Do you ever expect equities like Nvidia and Tesla to start listing Monday and Wednesdays? We've already covered this. I think I pretty much made my perspective clear on that. The underlying moves by $5. The option price with a 50 delta should move by $250. No. So if an underlying moves by $5 and an option has a 50 delta, remember, delta is expressed as a decimal as well. That would be 0.50. And so what that means, some people think about delta also as a percentage. And what you can think about it in that way is if the stock moves $1, the price of that option should theoretically move 50% of that underlying dollar. And so the option should move 50 cents for every dollar that it moves. And if you multiply that by 5, you get $2.50 of movement on a $5 move for a 50 delta option. This is only if you're buying options. If I'm selling options, this would be profit. So everything that I talked about can be applied to both buying and selling options. The reason why I kind of phrase everything this way is because I want you to think about optionality and time. Now, whether or not you're long or short options is a different trade altogether. If you are long options, you will theoretically be paying that theta amount because it's decaying out of the option that you're long. If you are short options, you are theoretically going to, quote unquote, receive that amount of theta. That's not guaranteed, but it is part of how the actual dynamics of being long versus short options works out. One thing that's really important, when you are long optionality, you are actually purchasing the right to exercise that option or the rights that come with owning that option and being able to convert it into its deliverable. Sometimes they have deliverables of cash, right? These S&P options deliver to cash. They're called cash settled options. However, sometimes options deliver to underlying stock. Someone mentioned Tesla before. An option on Tesla is going to deliver, its deliverable will be 100 shares of Tesla for every one lot. So it's important when you think about being long versus short, that being long gives you rights and being short incurs obligations. So if I'm short an option and I get assigned on it, my job, I've incurred the liability of making that contract whole, meaning I have to deliver its deliverable. The person who's exercising that option is expecting that deliverable to be delivered to them. I have to incur the liability of making that contract whole. Now, the difference between being long and short optionality is that because of the fact that you own the rights when you're long options, you pay for that right. And when you sell options, you are selling the premium of that option to the other person. And thus, you are actually incurring the liability, but you also get to collect that amount of money immediately. Anytime you trade, if you buy options, the money comes out of your account immediately. And if you sell options, the money goes into your account immediately. And it stays that way. However, the option itself trades and gets marked on a daily basis, and your account will change valuation based on what that mark is and how many of those options you have on. So that's the difference between being long and short optionality.
Matt, I think if you want to do like one more question, that'll be probably all the time that we can tie it up.
Yeah, no, I get it. We went a little bit long.
No, it's been great. Thank you.
Let's see. Let me find a good one. Sorry. Okay, so 0 DTE, is it best to trade in the money or out of the money? That's a question that's really hard to answer as far as that's concerned. Zero DTE is more a function of time than it is anything else. So I want you to consider that in the way that I talked about at the beginning when you're talking about time and delta, because when you're talking about in the money versus out of the money, you're talking about delta. You need to think about the fact that if that option starts the day as an in the money option, it is going to become more in the money as the day goes on if nothing changes. And if that option starts the day as an out of the money option, it's going to become more out of the money as the day goes on if nothing changes. The reason why this is important is that if you are buying or selling these options and hedging them with an underlying, like hedging them with futures, the futures don't necessarily have the same duration curve as the options do. The options are going to disappear at the end of the day. The futures don't have the same kind of decay as the options do. And so you might trade something that has a 10 delta and sell 10 futures against it. And then as the day goes on and nothing happens, that delta is no longer 10. Now it's 5. And so what you have is a 5 delta option with 10 futures against it or 10 equivalent underlyings against it. And so you need to think about what is happening to the delta of the options as time passes. That's really why I put this together in the way that I did, because I want you to think about more broadly, how does time affect things like delta, gamma, theta, and vega? All right, Stage. I think
Awesome.
that's all we've got today.
Yeah, thank you very much. If your question wasn't answered during the webinar, please feel free to send them to Matt at mcashman@theocc.com
Yep.
or visit options@theocc.com for more information. Also, if you have any suggestions or feedback for today's webinar, please feel free to send us a message via the Webull in-app help center or see us at webull.com. Matt, thank you very much for your time. This is very informative and look forward to more in the future. So thank you.
Thanks a lot. It's been a pleasure. Have a great day.
You too. Thanks, everyone. Bye.